When you own a home, you build equity as you pay down the principal balance on your mortgage, and also when the value of your property increases. If you've owned your home for a few years, you'll likely have accrued thousands of dollars in equity. And if you at some point need money for a major expense, then a cash out refinance may be right for you.
A cash out refinance replaces your existing mortgage with a new, larger loan that is based on the current value of your home. You use the larger loan to pay off your old mortgage and keep the difference in cash. You repay the cash you took out as part of your new mortgage payment over a longer period and at a lower interest rate than you can get from most other sources of credit.
How much cash you get depends on the value of your home. An appraisal will help your lender determine how much of a loan you qualify for. In general, lenders let you borrow up to 80% of the value of your property. Some lenders may make the exception and let you borrow more if you have a great credit score.
So why do a cash out refinance? You may need cash for any number of reasons. Maybe you want to renovate your home, are facing an unexpected and expensive repair, or you have a child who needs money for college. You also might use a cash out refinance to pay down high interest debts like credit cards or student loans. Some people invest the cash if they expect to make more on the investment than they'll pay in interest.
How is a cash out refinance different from a home equity loan or HELOC? A home equity loan and a home equity line of credit are other ways homeowners can borrow their equity.
A home equity loan is a separate loan you take on in addition to your mortgage. A HELOC sets up your equity as a credit line that you can spend as needed, much like a credit card. HELOCs usually set a draw term of about 10 years, during which the homeowner can use the credit line in making monthly payments to cover the principal they borrow plus interest. After the draw term, they can withdraw no more money and must pay back the outstanding balance, generally over a 20-year span.
Both a home equity loan and a HELOC are debts taken on in addition to your mortgage, and each will have its own terms and repayment obligations. On the other hand, the money you get in a cash-out refinance is repaid as part of your new mortgage, meaning you have only one set of terms and one monthly payment to worry about.
Getting a cash-out refinance is similar to getting a mortgage. The lender may consider common factors such as your debt-to-income ratio, the value of your home, and your creditworthiness. Some lenders require a higher credit score for a cash-out refinance than for a standard refinance because of the extra risk involved.
Cash-out refinancing saves you the most money when you secure an interest rate lower than you pay now. But if your new rate is higher, expect to pay more in the long run.
To refinance, you need an appraisal, which will cost from $300 to $500.
Just like when you took out your current mortgage, you have to pay closing costs when you refinance. Expect them to run you 2 to 5% of the loan amount. Depending on the lender, you may be able to avoid paying closing costs up front by rolling them into the balance of your new mortgage. You may have to pay a higher interest rate to do so.
If your lender lets you borrow more than 80% of your home's value, expect to pay for private mortgage insurance. This policy protects the lender against losses if you're unable to repay the loan.
Refinancing is not an overnight process. It takes time to go through underwriting and get approved. Even after closing, you have to wait a few days to get your cash. If you need money quickly, that's a factor to consider.
While cash-out refinancing requires careful consideration, time, and effort, it can offer homeowners an affordable way to borrow money for major expenses. Thanks for watching.